Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I wanted to update you on my 67-week-old dividend portfolio where I've been investing basically $230 a week or about $1,000 per month. So I started this portfolio, as you can see here, on February 10th of 2010. So if you look at my cursor, that's when I started the portfolio, and we are now sitting at $20,467.84 for an overall gain of $3,260, which is basically a money-weighted return of 42.64%. So that's pretty good. The reason for this is because I started dollar cost averaging right before the market crashed in March of 2020, and I've kind of just been riding this wave all the way up. So if you remember my last video, I was sitting at about $16,000 or so. So the portfolio has grown about $4,000 over the past couple of months. So you can see here, this is using M1 Finance. And again, if you haven't used my M1 Finance training, it is completely free. You can get that down in the link below. All you have to do is give your email address. There are no strings attached. I promise it is 100% free. It'll basically show you how to use M1 Finance and how I use M1 Finance. So if we take a quick look at the portfolio here, we can take a look at what exactly I'm investing in and also all the different weights of the portfolio. So you can see here that my highest weighted holdings are both VYM and VIG, which are Vanguard's high dividend yield ETF and also its dividend appreciation ETF. My next biggest holding, and since this is a tax advantaged account, it's a SEP IRA, it's not a taxable account, I decided to put 10% into VNQ, which is Vanguard's real estate ETF, which are REITs, which are real estate investment trusts. If you're not familiar with what that is, they throw off very healthy dividends. Next, you can see here is SCHD, which is Schwab's U.S. Dividend Equity ETF. And then we have individual stocks such as Visa, Verizon, Procter & Gamble, Johnson & Johnson, Walmart, Pepsi, AT&T, 3M, HDV, which is an ETF. It's not an individual company. Texas Instruments, Genuine Parts Company, BlackRock, Cisco, Pfizer, Hormel Foods, Prudential, Snap-on, Coca-Cola, M&T Bank, General Mills, Cardinal Health, Kimberly-Clark, Eversource Energy, and Medtronic. Okay, so as always, you can see the goal of this portfolio. I don't care if you guys like this or not, it's just the truth, that this is to build a dividend/income portfolio that pays me $1,000 a month passively in retirement. This may or may not be a Porsche 911 fund, and that is the truth. So let's move on to dissecting this portfolio a little bit here. But before we get into this, I'm actually allowing my subscribers and viewers to contribute to this portfolio. So every week, if you go to my channel and click on it, simply click on my channel name wherever you see it and click on the community tab, you can vote on all these polls. And I've been doing these polls for about 66 weeks now. So you can see what happened from the last poll that you guys contributed to. You can click here and see my live dividend portfolio at any time for that week. And then you can see the investment criteria for which I'm picking these stocks and ETFs to fund this portfolio on this link right here. So basically the poll that I started, which was earlier today, about 7 hours ago, was basically Cisco versus Eversource Energy. And then there's always an option to show the results if you're not comfortable voting. And I highly encourage you to comment. There's always a lot of funny and insightful comments there. So whatever you guys end up voting on will actually go into my portfolio. So you can see my portfolio here. I'm using simplysafedividends.com. I'm not sponsored by them. In fact, I actually pay for the service, but I enjoy using them because it gives me 100% clarity on what's going on exactly in my portfolio. So you can see here it's saying the balance of this portfolio is $104,000. That's actually because I'm tracking both of my M1 Finance portfolios in here. I have a taxable with 84 grand in it, and I have a retirement account, which is what we're looking at right now, which is the dividend portfolio, which I am going to be updating. So what I'm going to do is I'm going to click on portfolios, click on Marco's dividend portfolio, and then we can actually start to dissect this. So you can see here the portfolio, it is a delay just a little bit. The amounts are different, but we're talking about, a couple $100 here. You can see that the portfolio is throwing off $538 in annual income. So people always say that, oh, these are clickbait videos, these are clickbait titles. Why are you saying it's $1,000 a month dividend portfolio? Well, A, I'm investing $1,000 a month. B, I'm trying to get to $1,000 a month. So in my opinion, that isn't clickbait. I'm just showing you the path, okay? It's going to take probably over a decade to get there, to be quite honest. But slow and steady does win the race. So you can see here that the dividend yield of the entire portfolio averaged down is about 2.66%. So basically that is almost, you can look at that kind of like an interest rate, if you will. So if I have, $100 grand in this portfolio, I'll be making $2,660 per year. You just divide that by 12 and you get your monthly income from your dividends. So the things I wanted to touch on this video, well, you can see the tabs up here, which I'll get into later. But I wanted to talk about the dividend safety. The cool thing about Simply Safe Dividends is that they kind of have their own proprietary system of seeing if your dividends are safe or not. And you can see here that about half my portfolio is gray. And the reason for that is because it doesn't track ETFs. There's just too many individual companies in these ETFs. But for the individual companies that I do own, which I just showed you, you can see that 40% of my portfolio is likely safe for the dividend to be maintained or grown. Or you can see that 7% may be unsafe, which where the dividend may be cut, okay? So you can see the definition here. If you want to read their definition, feel free to pause the video right now. So the reason that 7.3% of my income is unsafe is because AT&T just got downvoted. So if I go back to my community tab, the reason for that, I actually had this right here, is the poll for week 64 was to either remove AT&T, keep AT&T, or show the results. So you guys voted 46% to keep it, so I ended up keeping it in my portfolio. However, the reason for that was because of this news from a couple weeks ago. So basically, if I click on AT&T here, you can see here that it shows you what the market value is within my portfolio, the percentage of my income, total cost, number of shares I own, et cetera, et cetera. You can see here that they actually have plans to combine media assets with Discovery, but also to cut their dividend in mid-2022. So the reason I like Simply Safe Dividend is because it curates all this information in one convenient spot. And again, I'm not sponsored by them. I get no money or compensation by mentioning them, but this is how you become an intelligent, informed investor. This is how you can actually start to make great decisions within your portfolio. So with that little blip there, that's pretty much the only percentage of my portfolio that's looking unsafe, to be quite honest. So if we go back into it, the one thing I wanted to talk about was the dividend growth, which is 3.5% per year, which is pretty healthy on average. And you can also see that I love to harp on this because I'm well diversified within this portfolio, and I do this consciously. So you can see here that based on this, without the ETFs, once you incorporate the ETFs, I actually have a lot of real estate and energy and materials as well. So the portfolio is actually even more diversified than what this would lead you to believe, okay? So no matter what sector does well or doesn't do too well, this portfolio has seen pretty steady growth, and that's what I'm looking for in this type of a portfolio. This is a retirement portfolio, you guys. This is not a AMC, GameStop, rocket ship emoji, flame emoji to the moon kind of a thing, right? So you can see here that if you look at the income forecast based on 3.5% per year, and with me reinvesting these dividends, assuming 3%, and a annual dividend growth of 6.5%, with me contributing $1,000 per month, which is $12,000 per year. You can see here some of the income forecasts that they have for me. So this x-axis over here is the year. You can see year 2026, 2031, 2036, et cetera, et cetera. And then you can also see the growth rate at which these stocks are growing. This will give you a predicted income per year. My calculations are coming out to be just a little bit higher. So if I go over here to Dividend Ladder, you can see that my starting principal is $20,467, which you can see right here, just taking it straight from what I own right now. With an annual addition of $12,000 a year, $1,000 a month, invested for the next 15 years with an expected increase of 7%. That's typically what the market has averaged over the lifespan of its history. Anywhere from 7 to 10%. I'm being a little bit conservative here. You can also see an average annual dividend yield of 2.66%. That's simply just using my Simply Safe dividend numbers. You can see here that after 15 years, you can see the value of this portfolio is going to be just under $500,000. You're going to see the annual dividend income being just over $12,000 a year, aka $1,000 a month. You can see the amount of dividends paid out over the next 15 years, with an average annual return of 8.43%. So I know a lot of these percentages to growth investors or people that are just YOLOing into meme stocks at this point seems very low. But again, you guys, this is a dividend growth portfolio, and it's in a retirement account. It's in a tax-advantaged account. So not only am I averaging this annual return of 8.43%, but I'm also realizing tax benefits as well. So that concludes the portfolio analysis portion of this video. What I like to do in these videos is leave you with just a little bit of news or basically some sort of fun fact. So for the next 2 minutes, I highly recommend you check out the Dow turning 125 years old and looking at this chart. The reason I want to show you this is because a lot of people, they have very high time preference, meaning they want to invest very they want to trade basically instead of looking at their portfolio as something that you build over the period of decades, 10, 20, 30, 40. I hope that this was educational for everybody. Please check out my free training down below for M1 Finance. I have over 6 figures invested with them, and I'm very happy with my time with M1 Finance. I've been with them for about 1.5 years now, and it's just an easy way to dollar cost average into the market. So if you believe that inflation is coming, well, that typically rises all asset prices, real estate and stocks, right? So if that's the case, that's why I'm dollar cost averaging using M1 Finance. As always, please share the video with a friend, share it on social media, Facebook, Twitter, Instagram, TikTok, whatever the kids use these days. I am actually going to be packing my bags. I'm going to the Bitcoin conference literally in about 12 hours. My flight leaves at 7 in the morning. I'm already packed. Got my Nike sandals on. I don't know if you can see that. I'm ready to go. And if you're wondering about these big ass bruises all over my body, I had 6 soccer games over Memorial Day weekend. I am smoked. Okay, I got the compression legs on. I got the ice packs. I got the foot massager going. I'm done. I'm in my early 30s. I can't play 6 games anymore in a 2-day period. But I say that every year and I end up playing and enjoying it. So, all right, everybody, thank you so much. Please share the video. And as always, have a prosperous day. Peace.